With the stock market trading near all-time highs, some investors are looking to diversify risk away from stocks into places less correlated. They're also looking for something a bit more robust and liquid than, say, Pokemon futures. Today's audience requested triple header is between three such ETFs. Stick around. This is ETF Battles. I'm Ron DeLegge, and a cordial welcome to all. If you're new to this show, welcome aboard. Now, we're in the midst of Season 5, and this is where we congregate to analyze audience-requested matchups from you of ETFs versus each other with the purpose of helping you to make informed investment decisions. If there's a certain ETF battle or contest that you'd like to see, send me your ETF tickers in the comments section below, or you can also hit us up on our X feed at ETF Guide. Now, don't forget to visit the description section below. The reason is I've got links to our program judges, get in touch. Plus, I've got links to our program sponsor direction. And finally, I've got links to lots of viewer resources, including free audio as well as ebooks and other goodies. So don't miss the description section below. Today's ETF bout was requested by a viewer named Devil's Claw. And today we're going to analyze a triple header. We've got CAOS from Alpha Architects, BTAL from AFG, and GCC from WisdomTree. Judging today's matchup are two of the top minds in the ETF industry. We've got Shana Sissel with Banrion Capital Management and Tony Dong, the lead analyst at ETF Central. Judges, welcome back to ETF Battles. Great to see you.
Great to be here.
Thanks, Ron.
By the way, we do take requests for certain judges for certain ETF battles. Today's battle, we had a request for Shana, so just keep that in mind for future battle requests. We will go backwards and forwards to please viewers, but sorry, we still won't pick up your dry cleaning and groceries. Now, our four battle categories are cost, exposure strategy, performance, and mystery. For the mystery category, that's where our judges can surprise us with any factor or thing that they feel is crucial to today's contest. Our judges can also nominate wildcard ETFs if they feel there's better choices elsewhere, or they can opt for split decisions. I've got the scorekeeping chores, and at the end of the program, we'll declare an overall winner. Keep in mind, none of the battle outcomes are ever predetermined or known in advance by myself or our judges. The first category is cost. Shana, please get us started.
Absolutely. So we're talking about three alternative ETFs that are doing some highly sophisticated types of investing. In the case of GCC, it's commodities. CAOS is doing a tail risk strategy using options. And BTAL, which is an equity market neutral long short fund, goes long low beta and short high beta. So all of these strategies cost a little bit more to execute. And so you'll see that reflected in their expense ratio. Now, that said, for an alternative funds, all three of these funds are fairly well priced. GCC at 55 basis points, CAOS at 63 basis points. And the headline expense ratio for BTAL is 143 basis points. But if you read the fine print and you kind of look through the prospectus, you'll find the actual expense ratio is 45 basis points. And that has to do with a number of things. They have some rebates that are involved there. But also, of the three funds, BTAL is the only one that is shorting stocks. It's the only one that's doing any sort of actual shorting where they have to borrow a security. And when you do that in the mutual fund, the SEC requires that you calculate in your expense ratio the borrowing costs, the interest on the borrowing costs, as well as you calculate the cost of paying the dividend back to the shareholder you borrowed it from. But those are kind of like phantom costs because those are also calculated in the actual pricing of the security that's short, right? Because the value of that security is calculated and you subtract out the cost of the dividend and the cost of the shorting. So that is the explanation for why you see 143 basis points, but the actual is 45. And so for that reason, BTAL is my winner. It trades fairly well with a reasonable spread and has the lowest expense ratio, actual expense ratio. But I wanted to point that out because it's not obvious unless you kind of know the nuance here. So BTAL is my winner.
Thank you, Shana, for those added details and conducting some brain surgery on the ETF category cost. What a way to kick off the show. You're up next, Tony. How do you see it when it comes to cost?
So like Shana mentioned, the ETFs in the alternative space have a big advantage over their mutual fund counterparts in that their expense ratios are lower. For example, if I think back to a equivalent mutual fund from AQR, I think it was AQMNX, the net expense ratio is around 2.43%, somewhere around there. Now, ETFs are significantly cheaper, and I think this makes them a very viable part of your component. As to which one wins here, it's, again, going to be BTAL. I want to point out that GCC's expense ratio, while not too high, 0.55, it has a pretty brutal spread at 0.53, almost as bad as the expense ratio itself. So if you're going to be trading in and out of GCC, you're going to be eating a pretty big cost jumping in that position and jumping out that position. So just to recap, BTAL takes it here on costs.
That takes us next to exposure strategy. And Tony, you're still up. So give us your analysis.
These are very different. So GCCs are typical long-only commodity futures fund. So it can go long on precious metals, industrial metals, energy, agriculture, and actually even Bitcoin and Bitcoin futures. So this is the ETF to buy if you're looking for inflation protection primarily, and you don't mind using futures. AGF, on the other hand, is a long-short fund. So it goes long on low beta equities, and it goes short on high beta equities, right? And it seeks to exploit the difference in the spread between those two positions. CAOS is the most complex of them all. So it holds another Alpha Architects ETFs called Box, which itself is already complex as heck. It uses a box spread to deliver the returns of 1 to 3 month T-bills. Adding onto that box position is an active options overlay consisting of purchased and sold SPY calls and puts, and that's designed to provide you with that downside protection, the so-called tail risk, these 3 standard deviations to the left events that come out of nowhere and hit you hard like COVID did. But again, this stuff costs money and it's hard to maintain, which is why you see a lot of tail risk funds have negative carry. Their net asset value grinds down month over month over month. CAOS tries to avoid that using their secret sauce, which I am still at the moment trying to figure out. So for me, in terms of exposure, I am actually going to throw my wild card here, which is KMLM, the KFA Mount Lucas Managed Futures Index Strategy. Once again, this is 11 commodities, 6 currencies, and 5 global bond markets. So it has no equities in it. It contributes to a lower correlation with the equity markets. But unlike GCC, you're able to go long or short using a trend following strategy on these. And these 3 baskets of commodities, currencies, and bonds are weighted by historical volatility. And I think the benchmark goes way back to 1988, but we could talk more about that later.
Excellent. Shana, you're up next on exposure strategy. How do you see it?
Well, that was excellent analysis by Tony. I agree with him wholeheartedly. He did a good job explaining the 3 different products. For me, when I'm looking at exposure strategy and I'm looking at alternative funds, my goal is to find funds that have low to no correlation to general fixed income and equity. And Tony just pointed out KMLM, a managed futures. I have a managed futures wild card to throw in there with CTA, which is the Simplify Managed Futures Fund. Same idea, though, going long and short. I feel very strongly that is a better diversifier. Managed futures are historically a excellent diversifier in portfolios. Prior to being available in an ETF wrapper, these were typically CTA and involved in hedge fund-like strategies, CTAs. Not just the ticker of the Simplify fund, but also a structure. And so having access to that is good. But for me, of the 3 in the actual battle, BTAL is the most diversifying by far. It also has negative correlations to equities and almost 0 correlation to fixed income. I like that the strategy is actually kind of intuitive. So if you believe that the long-term academic research that low vol does actually persist and outperform, this strategy is basically low vol on steroids because you are long low vol and you're short high vol. There's downsides to that, of course, because you're neutral. You're taking an equal bet on the long and the short side. So what you get is the arbitrage there, the difference. So as long as low beta stocks do better than high beta stocks, you win, even if both are negative. So if one's down 2 and the other down 4, you're +2. And so that is the benefit of this type of strategy. So for me, BTAL is my winner.
That takes us next to performance. And this is where it really gets interesting. Shana, break it down for us.
So because these are 3 really different strategies, they have 3 really different returns histories. For me, just for the opportunity for persistent, strong returns in the negative correlation, BTAL is my winner. I'm going to throw a wild card in here. If you are someone who is looking for downside protection and you don't like the negative, like truly negative correlation of BTAL, but you want to have that hedged effect, I'm going to throw MRSK into the mix, which is a hedged strategy that's run by Taze Asset Management that has some very strong returns and high correlations to equity markets with downside protection. So think of it as almost a alternative to a buffer fund because you don't have to worry about entry points and exit points. It is evergreen and buffer funds are not, but it has a similar return pattern to a buffer fund with upside that has some limits because of the nature of the strategy, but it has a downside floor. So MRSK I'm going to throw in there as a wild card. I like that in performance, but BTAL in terms of the 3 funds that are in this particular battle, those are kind of my 2.
Tony, you're up next. How do you see it when it comes to performance?
Yeah, so these 3 funds protect from very different scenarios. Something like CAOS is intended to protect you from a sharp, extreme downturn like during COVID, right? We saw that V-shaped recovery. That's what CAOS is supposed to protect you from. BTAL, on the other hand, is very suited for a situation like Shana's. If we see a reversal of the market conditions we see today, where it's high beta, right? If those low beta stocks start outperforming, that spread widens, BTAL is the most beneficial. And then GCC is for years like 2022, where inflation is kicking your butt and commodities are going through the roof, and you want that future sleeve. But overall, I think out of the 3, BTAL is going to be your best option because the whole point of these strategies isn't to get the highest possible returns. If you want that, just load up on equities. These are designed to provide you with that non-correlated stream of returns compared to stocks and bonds. If you think about your 40-30-30 portfolio, 40% stocks, 30% fixed income, and 30% alts, these are the funds you want there. And by having a market neutral fund, you are explicitly removing market risk, which is the whole point of this, right? I am still going to go with my wild card, KMLM, because in terms of performance, right, it doesn't have a track record during COVID, but it held up through 2022 very well because it had those commodities, it had those currency futures, and it was able to go long and short on individual ones and weight them by risk to deliver that positive return in 2022. And it still has a very low correlation with the rest of the market. So my vote here goes to KMLM.
Thank you, Tony. And since the start of this episode, I just want to say that my IQ has been raised a few points by just listening to the level of world-class analysis that our judges are bringing. So I hope our audience is appreciating it as much as I am. The next category is mystery. And this is where our judges can pick a certain factor or thing that they think is pertinent, meaningful, crucial to this matchup. So, Tony, you're still up. What is your mystery battle category, and which of these 3 ETFs wins it?
It's going to be track record. The 2 things I always watch out for when I'm looking at an alternative strategy are 1, track record, and 2, firm-specific risk or strategy-specific risk. A lot of these strategies and what they do can vary between the manager. And not only that, these strategies can change over time. And the term for that is called style drift. The alternative strategy that your dad had 10 years ago, it may be still offered under the same manager, under like the same name, but it can be doing something very, very different now. And that's the reason why I like KMLM, because although the fund is new, it is benchmarked to an index that has been around since 1988, the MLM index. So this is a very old benchmark that provides you with an indication of how a pure systematic trend following strategy has worked over time. So we get a very clear idea of how this premium has been. And since its inception, it's done very well. Of course, KMLM is going to lag it a bit because, well, the cost of the fund, it costs 90 basis points, which is fairly expensive. And also just, the cost from trading, friction from imperfect replication. But the lads over at Mount Lucas have done a fine job recently with it, and I think this is it's a pretty reliable background we can base it on.
Got you down for KMLM for your mystery battle category. Thank you, Tony. Shana, you're up next. What is your mystery battle category, and which of these ETFs wins it?
So I'm going to spend most of my time here on this mystery category, actually giving some insights into one of the funds in the battle, which is not going to win the category, but what I have to say is really relevant to the battle. Tony kind of alluded to it, and he kind of teed me up for this because we talked ahead of time. But it's CAOS. So CAOS, Alpha Architects Tail Risk Fund, it's really important to note that an investor may find it confusing. On the Alpha Architect website, the fund is shown to have an August 2013 inception date. But then if you were to go to Morningstar or ETF.com or any of the other areas where you can do analysis on ETFs, you'll find no track record. And that's confusing because those websites will tell you that the fund was incepted in March of 2023. So why the discrepancy? Well, as it turns out, Alpha Architect converted a mutual fund that used to be run by Arin, A-R-I-N. The fund used to be called Arin Large Cap Theta. And the express purpose of that fund was to use options to actually kind of soup up the returns against traditional large caps. If you look at the history of that product initially had a express purpose of just using options as kind of an overlay. It's been a little while since I looked at the actual prospectus. However, what the point I'm trying to make is the prospectus mandate on this fund has changed 3 times in the last 4 years. And the first mention of this fund using the strategy as it persists today is 2022. So if you were to look at the history of the prospectus changes that were made by the previous manager, it is not until the filing in 2022 with the SEC where they make any mention of this tail risk strategy. So I think it's really important that potential investors be aware that the track record that's shown on the Alpha Architect website that goes back to 2013 is based on a mutual fund strategy that is different from what is actually being implemented today. So yes, it was a fun detective job here. It was fun doing the investigation for sure. I think it's important, again, to note that. And so in that vein, CAOS is not my winner of this category. When you think about funds that have consistent prospectus, easy to understand, consistently implementing a strategy in a really systematic way, BTAL is my winner because BTAL's strategy is actually quite simple and easy to understand. They actually created the index that it is based on, and it is executed on that exact mandate since the fund launched in 2011. So BTAL is my winner, just looking at it in the aspect of the fund consistently implementing exactly the same strategy for the life of the performance.
All right. Some great points brought to our attention. Thank you very much, Shana. And now we've arrived at the part of the program where our judges can give us their overall battle winner. So thus far, if you're lost track, I haven't, but we've had 3 wild card choices and lots of amazing analysis on the 3 ETFs thus far in this battle. So which of these ETFs will be the winner? Shana, you're up. Give it to us.
All right. So for me, I can't choose one. So I have a wild card and BTAL. And I want to start by saying, I don't feel like if you're going to use alternative ETFs, and I love that Tony said a 40-30-30 portfolio because I love a 40-30-30 portfolio, but I find that more often than not, people are more comfortable with a 50-30-20. When you are going to do an alts allocation, you should build it like you build equities or fixed income. You shouldn't just choose one fund. In fact, you can get the best bang for your buck by combining 3 to 4 alt funds together that are uncorrelated to the markets and to each other. So I'm going to actually give you 3 funds that I would put in this mix that actually serve that purpose. So I'm going to put BTAL, my wild card from earlier, MRSK, and GCC, although I have a preference for managed futures, so for me, CTA, into a nice little portfolio, evenly split. And those 3 products are very little correlation to each other and very little correlation to the markets. And you get upside participation when equities are doing really well with MRSK with some downside protection. You get BTAL that kind of takes the market risk out and protects you on volatility. And then you have CTA or GCC, depending on what you want, where you're getting that inflation protection. CTA being a managed futures oriented account gives you that negative correlation. GCC is a little more positively correlated to the equity markets. But either way, you're getting some futures, commodity exposure, protection from inflation. And I think that is the magic combination of funds that you would want to have in there. I actually have, when I build alts portfolios, I do it with 4 or 5 funds. But I to simplify it for the audience and stick kind of in the silos that we were given, those are the 3 that I would put together. So I have a tie between BTAL, MRSK, and CTA along there. And for full disclosure, we work with all 3 of the firms that are the issuers of those, but that's not why I like them. I've been using BTAL. Anybody who knows me, I'm talking about this fund for 7 years. And Tay's same thing. And Simplify is using some stuff that used to be hedge funds. My point here is I like those 3. Those are my winners.
Thank you, Shana. Tony, your final chance to weigh in with your overall winner.
So what Shana has there is a pretty comprehensive alternatives bucket or sleeve, and she's doing it the right way in that she's minimizing, not minimizing single manager risk, right? It's just, again, styles change, and because these are 3 so different types of alternatives, it's actually very beneficial to layer them. I'm a lot more lazy. My alternative sleeve is a fairly small amount of my portfolio, so I'm just looking for that one fund that gets it done, that targets asset classes that are not in my traditional equity or fixed income sleeve. So that for me, again, is KMLM, just having liquid to those different futures contracts. Not only are they in commodities, but also in currency and treasuries, and being able to go long or short using a very systematic, time-tested trend following model is incredibly beneficial. So for me, it just goes to KMLM. Of course, if you already have a commodities allocation, or maybe you have currency exposure and you just want to like hedge out some of that straight up market risk, BTAL is the natural fund to do it. But that's not me. And so personally, I go with KMLM, and disclosure, I am long this ETF in my own portfolio. All
right. Well, our judges have spoken, and according to our battle scorecard, today's winner is a split decision, a 4-way split decision between BTAL, KMLM, CTA, and MRSK. And of course, Shana offering up 3 wild cards. I actually strike that 2 wild cards, CTA and MRSK, which she mentioned, instead of trying to use a one fund solution, she endorses a multi-fund or multi-ETF strategy for getting alternatives exposure. And again, she highlighted all of those ETFs very well and made some strong arguments. Tony opting for KMLM. He likes that multi-asset class approach, the different asset classes, and of course, making his arguments very, very strong and clear. Great job to both of our judges for breaking it down on today's episode of ETF Battles. Well done.
Thank you so much for having me, Ron. This was fun. You can't do an alt battle without the queen of alts.
It was a pleasure, Ron. Thank you.
Well, a couple key takeaways for today's episode. Performance history can be super sneaky from ETFs that absorb mutual funds with a longer-term track record, but then all of a sudden change the fund's investment strategy. Oh, my goodness. While that's not illegal, it's definitely confusing and could cause unsuspecting advisors and investors to arrive at inaccurate conclusions. namely attributing long-term historical performance to a certain investment strategy when the fund only recently adopted that strategy. And so most of its performance history in reality is linked to a strategy that's no longer actively used. Oh my goodness. How confusing is that? And shame on regulators, by the way, although they enforce and ask for disclosures, what good are disclosures if they're buried in places investors aren't going to look or can't easily obtain or find? So shame on regulators on that front. But again, given the rise of mutual fund to ETF conversions, especially in the active universe, it's not just buyer beware, it's also buyer be aware. And I think our judges brought that to light. Great job again by Shana and Tony. And a big thanks to Devil's Claw for this episode of ETF Battles. I think it was a great suggestion, and we appreciate that. So what about you? Did you enjoy today's episode? I mean, there was a lot of meat to today's conversation. And do you think that we should be doing a certain ETF matchup that's on your mind? Well, let us know in the comment section below or on our Twitter feed, actually X feed at ETF Guide. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you on the next episode.